Okay, traders, let's quickly talk about risk management, how to apply proper risk management in your trading. So, without risk management, then you're bound to fail in trading. That's the fact. That's the only thing I have to say. So, if you want to be that successful trader, you need to know how to apply proper risk management. Even if you don't know anything about risk management, I advise you to watch this video, learn some things about risk management, and study more about risk management. So without wasting much of your time, I'll quickly give you insights on how to manage your risk. So firstly, if you are yet to subscribe to this channel and you are just coming across this channel for the very first time, kindly hit the subscribe button, like this video, share this video so that others can benefit. Also, we have a Telegram channel where we drop free signals and market insights. I'll drop the link in the description of this video for you to join if you are yet to join our Telegram channel. So now, what is risk management? Risk management is the cornerstone of successful trading. It ensures that even when trades don't go as planned, your capital is preserved, allowing you to stay in the game long enough to achieve profitability. Managing risks effectively involves understanding your risk tolerance, setting appropriate limits, and following strict guidelines to protect your account from significant losses. So, you see why risk management is very important in trading. So, and first thing you need to consider in trading before we even go further is for you to get a good strategy. I hope you get. If you get a good working strategy, really works and you have tried it, maybe back tested it and it works well, then you can now start applying proper risks. If, for example, you lose, let's say, even if, for example, you lose 8 trades or 7 trades with just 3 wins, for example, or 4 wins, then still it won't take you out. It won't liquidate your capital. How would you get it? So the first thing is to get a good strategy. That's your number one thing. Then the second thing is to determine your risk per trade. Decide how much of your account you are willing to risk on a single trade. Each particular trade, you need to decide how much you are willing to risk even before taking that trade, right? You need to know how much you want to lose as per your capital, the size of a capital. Let's say, for example, you have a 10,000 capital account size, for example. Let's say you have a 10,000, let's say, for example, you have a 10,000 account capital, right? $10,000. So you have a $10,000 and you want to risk 1% of $10,000. You want to risk only 1% of 10,000. So that means in any trade you lose, you only lose how much? You only lose $100. Just $100 in any trade you take. So imagine how many $100 you will lose before it gets to this $10,000. You see, this is part of risk management. So your account size must not be $10,000. Just use this formula. Get your account size, then calculate 1% or 2%. If we are using 2%, that means you will be losing $200 in $10. You will be losing $200 per trade. So, but in this case, if you lose $200 or $100, your TP, you should be targeting in $100 loss trade, you should be targeting like 200, for example. Meaning you are risking $100 to get 200, right? Or in $200, if you are losing $200, then you should be targeting in that trade to get at least $400 and above. $400 plus. Year two, $200 plus. So if this trade goes to, let's say, $400, if this trade goes to $400, this particular trade, if it gets to $400, that means, and you hit profits 2 times, which is like $800, right? And you lose trade, let's say 3 times, for example. You lose trade, let's say 4 times. Imagine this is just 2 trades. And you lose trade 4 times, for example. 4 trade, you're losing trade, your loss is $100, right? In this scenario. So meaning if you lose 4 trade in a row, or in all, you are losing $400. So just imagine that you see you are still in profit. If you calculate this, you still have profit of $400. I hope you get this strategy. So it is very important to know how to manage your risk, to determine the risk per trade. You get, before even taking that, you just know that, okay, this is my account size. Let's say my account size is $5,000. Okay, I'll be risking $50 in each trade. If you follow this rule, and I'll be risking $50 in each trade, and I'll be aiming to get $100 or $200 in each setup. My streamer, you know, the first thing I said is to get a good strategy, right? Right? So if you stick to this, then you are bound to be successful in trading. If you stick to this plan, don't mind if that's your setup hits your SL. Don't mind, because you already have a plan. You know, when you don't have a plan, you are bound to fail. So because you already have a plan, you already have a target, that this is your plan and this is your trading target, and this is your risk per trade. You are not scared of anything. I hope you get this. So the next thing I'll advise you is to always use a stop loss, right? Our first point was to determine the risks, right? To determine risks per trade. Our second point is stop loss your SL. Use stop loss orders on all trade. Don't be emotionally attached to your stop loss. Let's say you already put a stop loss and the trade is going against you. Don't panic. I hope you get, don't panic. Just be calm, because you already have a plan and a strategy. So let it go. If you hit your stop loss, there's no how it will liquidate your account, because you already have a plan. I hope you get, the stop loss is predefined price level where you will exit a trade if it moves against you. Set a stop loss based on technical analysis such as support and resistance levels, and not your emotion. I hope you get this. Don't attach emotion to setting stop loss. I hope you get this. Then next is diversifying your trade. Do not put all your capital in a single trade. That's our number 3 point. Because you see a setup and you want to take advantage of setup, then you put all your capital on that particular trade. You use big lot size. Use big lot size. It is a no. You already have a plan. If you are trading with, let's say, one lot size, please stick to that, your one lot size. Except if your capital doubles, then you can increase your lot size. But if your capital is, for example, is still 10,000 in this scenario, then please stick to your lot size, because you already calculated that, okay, in one standard lot size, in, let's say, for example, gold, if this trade goes against you, you will lose $100. But if this trade goes to your way, according to the strategy, you'll be getting $400 or $200, for example. I hope you get that. So just stick to a good lot size, not changing different lot size, putting big lot size, because if you think this market is will go to your favor, and sincerely, you know, this market, you can never be 100% sure. Even if you have a working capital, sometimes it goes against you. That is why you have a stop loss, right? So what if, for example, this trade goes against you? Instead of you now, to lose your $100 as planned, your $100 normally as planned, you will now be losing, let's say, $400 instead of your normal $100. So you see, you have gone against your plan. You have gone against your risk tolerance. So at the end of the day, you might end up blowing your accounts. So you need to be disciplined. You need to be disciplined, right? So also, another thing I would like to add to this is to avoid leveraging, over leveraging. Avoid over leveraging. We all know what leveraging is, right? Avoid over leveraging your account. You know, a leverage is when it's like you borrow more capital to open bigger lot size that is more than your total capital. Let's say, for example, you have $10,000 capital, and you added a leverage from your broker when you want to put the trade. Let's say you use if you're trading crypto, let's say use 50x or 40x, 30x, 75x, or if you are using the forex, if you are in the forex trading, you use 500 leverage, 1000 leverage, 2000 leverage. That is ridiculous. So, and imagine that you use over leverage, and at the end of the day, this will easily take you out of the market, because the broker won't want to hear that this market is going against you. The money they give you is there. Yes, they give you the money so you can open a bigger position. If this market goes well, you are lucky. But if this market goes against you, immediately is going down, they wouldn't want it to touch their own money. They will cut you out. Immediately it will liquidate you. They will cut you out because they want to protect their own money they borrowed to you. I hope you get this. So avoid over leverage. Then it's not like leverage is bad. No, it's not bad, but overdoing it is what is bad. You get, overdoing it is what is bad. So one last point, so I won't take much of your time, is for you to set realistic TP, please. Don't overdo this. Set realistic TP. What I mean by setting realistic TP, that is set realistic take profits. Do not aim for too bigger take profits. You get, do not aim, let's say you wanna target a profit. Like we started from beginning, just maybe use ratio of at least 1:2. It's okay. 1:3 or 4. It's okay. Don't go and say you want to target up to 6, 7, 8, 9, 10. And at the end of the day, the market might, first of all, be going your favor. And at the end of the day, the market will turn against you. You keep getting SL back to back. SL back to back. you get. So instead of you to risk, instead of you to aim 10, let's say to aim $5,000, it's better you aim for like, $200 and $2,000, for example. So like I said, set realistic TP. Use a risk to reward ratio of at least 1 to ratio 2. Meaning for every $1 you risk, you aim to get $2. I hope you get the point. So it is very important in trading. So last, before we go, you need a trading journal. Journal everything you do. Every mistake you do, journal it. Everything you do, every profit, everything you do, journal it. It helps a lot. It really, really helps a lot. Get a journal book. We also have a journal book here. You can search our platform to order if you want. Or you get any journal book. Just make sure you get a journal where you jot and write down every single thing you do. Every single mistake you do, write it down so you don't repeat same mistake, right? So, effective risk management is not just about numbers, it is about mindset. Know this, it is about mindset. So stay disciplined, stick to your plan even when tempted to chase losses or increase risks. Accept losses. Understand that losses are a natural part of trading. Focus on managing them, not avoiding them entirely. You get what I'm saying? Focus on managing your losses. There is no how you can avoid losses in trading. There is no how. It is never possible. Be patient. Build long-time success requires steady progress, not big risks or risky move. So, if you want to be successful, it takes time. You don't, you want to make all your profit in one day. No, it's not possible. So with this, I think we have come to the end of this, video. I hope you learned something out of this. And like I said, don't forget to subscribe to this channel. Hit that subscribe button. Share this video so that others can benefit. And also follow our social media platform. We have Telegram platform where we drop market insight and trading signals. We also have our TikTok and Facebook. Follow all our social media platform for updates. So see you in our next video. Bye-bye.